Hi, I'm Steve LaFrance with Blakely Financial. The second quarter is now complete, and the topic of rate cuts continues to dominate the markets. Investors are focused on when the Fed will lower rates, all while keeping a close eye on corporate earnings and valuations. Economists are analyzing inflation and labor market data to determine their impact on the probability and timing of rate cuts. And what we're seeing right now is an unemployment rate of 4%, which remains a historically strong number, yet it's the highest it's been since January 2022. Keep an eye on this as non-farm payroll data showed 272,000 new jobs were added in May, a solid rebound from the previous miss, and surpassing expectations of 185,000 jobs. So employment data is giving some mixed signals, but remains good. Inflation now registers at 3.27%, a decline of 0.1%, and the 11th consecutive month that year-over-year inflation has remained within the 3 to 4% range. This means the Fed continues to have a green light to maintain the rates at 5.5%, which is exactly what happened at their last meeting in June, marking the 7th consecutive meeting without a change. Investors are still expecting a cut by year-end as central banks around the world have already started lowering rates as monetary policies shift from tightening to easing. Equities experienced some ups and downs this quarter. In April, stocks traded lower, reversing some of the earlier gains from Q1. They rebounded in May, and the S&P finished Q2 by setting multiple all-time highs. One notable theme has been the outperformance of the largest companies. The S&P has gained 15.2% year-to-date. The Magnificent Seven, which I'm not recommending, but includes Microsoft, Apple, Google, Meta, Amazon, Nvidia, and Tesla, has returned 34.9% this year. If we expand the list to include the largest 50 stocks of the S&P, we see a year-to-date return of 21.8%. In contrast, the Russell 2000's year-to-date return is just 1.6%. And if we take an equal weight approach to the S&P, which tilts the portfolio towards the smaller companies, the year-to-date return's just 5%. Investors are clearly favoring larger companies for now, as they await clarity on Fed policy and the economy. In the interest of time, I'll simply summarize the international stocks have posted mid-single-digit returns this year, but are also underperforming the S&P due to lack of companies in the AI industry outside the US. And bonds are posting their best yields in over 15 years, but on a total return basis, remain relatively flat this year. The market is off to a strong start this year, with the S&P gaining over 15% led by the largest companies. Economic data has softened, raising the question of whether the economy is slowing or simply returning to normal. The second half of 2024 will be busy. Investors expect the Fed to start cutting rates before year-end. QT earnings season starts in mid-July, and the presidential election will take place in November. That's all for now. We'll continue to provide timely updates each month, so enjoy your summer, take care of yourselves, and thanks again for your trust and confidence.